Chapter 9 begins to bring things together for us. We'll start to see where all the parts we've been studying go together. This chapter builds heavily on the previous chapters, on valuing bonds and valuing stock, as these are the components of a firm's weighted average cost of capital. The weighted average cost of capital will be the basis for the discount rate a firm uses to value itself as well as to evaluate future investment opportunities. A firm typically only uses two major types of capital, debt and equity. Corporate debt usually means long-term debt, bonds. Short-term debt may be included, but if and only if a firm uses it as a permanent source of funding rather than to fund seasonal or occasional fluctuations. Equity includes both common stock and preferred. The capital components we're concerned with are strictly those that are sources of funding from investors. Other sources of cash, accounts payable, accruals, etc., are handled in the cash flow estimation process. They are not sources of investor-supplied funding. In finance, we're always concerned with after-tax costs. Only the cost of debt is affected, since only interest payments on debt are tax-deductible to the firm. We are not usually concerned with what the cost of capital was last year. We need to know what the cost of money will be going forward. Since it will be used to evaluate future projects, we focus on marginal cost, the cost of the next dollar of capital. Here's the basic weighted average cost of capital formula. The W's are the weights or percentages of each type of capital in the capital structure of the firm, and obviously they must add up to 100%. Short-term debt is included just for completeness, but will rarely be used in reality. The R's are the costs of the various types of capital, their required return. We've already learned how to compute each of those. And finally, T is the firm's marginal tax rate. Note that this is just a weighted average and could be expressed with a summation sign. Since there's a finite number of elements, we look at it in an expanded format. A more realistic version of the formula excludes short-term debt, and this is the version we'll be using. Frequently, a firm will have no preferred stock either, so that term may drop out as well, leaving us with only debt and equity. Let's start with the first capital component in the formula, the cost of debt. 3 ways to find it. If the firm currently has no debt outstanding, then asking an investment banker for an estimate of what coupon rate the firm would need to offer will provide a number. Or find comparable firms and use the current yield to maturity on their debt. The easiest, if the firm has debt outstanding, is to find the yield to maturity on the firm's current debt. This provides a good estimate of what it would cost the firm to issue new debt. Recall from Chapter 5 how to find the yield to maturity on a semi-annual bond. The yield to maturity is the cost of debt. Don't forget, semi-annual, so you have to double the resulting rate. Since interest on debt is tax-deductible, we need the after-tax cost of debt. So we multiply the nominal cost by 1 minus the tax rate. If the firm has preferred stock outstanding, then equation 9.5 will solve for the cost of preferred. Note that preferred dividends are usually paid quarterly, but the required return is an APR. The quoted rate of 10% quarterly means a quarterly rate of 2.5%. The above method using the annual dividend works as does the alternative on the next slide. Solving for the quarterly required return, then multiplying by 4, results in the same cost of preferred. Flotation costs on equity, common and preferred, are typically significant and should be considered. There's no adjustment for taxes on preferred returns. We arrived at a pre-tax cost of debt of 10%, 7.5% after tax, and a 9% cost of preferred. But preferred is riskier than debt. Debt is a contractual arrangement. Preferred dividends don't have to be paid, but interest on debt does. Firms usually do try to pay preferred dividends for several reasons. They can't pay common dividends if they skip preferred. It's a bad signal, making it hard to raise funds. If preferred dividends are skipped for too long, preferred stockholders can gain voting rights. Remember the tax exemption for firms owning other firms' stock? Most preferred is owned by other companies and is 50% tax exempt. Thus, the before-tax yield on preferred is lower than on debt, even though it's riskier. Here's an example. If preferred is owned by corporations using the 50% exemption, then their after-tax return is 7.875 versus debt's after-tax return of 7.5, which is consistent with a risk premium on preferred. Finding the cost of debt and preferred are relatively simple compared to common equity. There are two ways a firm can raise common equity: use retained earnings indirectly, issue new stock directly. Retained earnings have an opportunity cost. What else could have been done with them? They could have been paid out as dividends, allowing investors to buy other securities. The firm must earn at least what investors could earn on similar investments of equal risk. The firm could always repurchase their own stock, so there's a cost to using retained earnings. There are three methods to determine the cost of equity, two of which we covered in Chapter 6 and 7. The own bond yield plus judgmental risk premium is a back-of-the-envelope technique used as a check against the other methods. Using CAPM, Chapter 6, and the given data, we can easily find a cost of retained earnings equal to 12.8%. Be aware, however, that virtually all the variables needed to use CAPM are proxies or estimates. Both the risk-free rate and the expected return on the market are proxies, and betas are noisy. Most analysts use a long bond rate as the risk-free rate in valuing stock. Recall in Chapter 8 that we chose a short-term T-bill rate for the risk-free rate to value options, which are short-term instruments. Stock is a long-term asset, thus a long-term rate is appropriate. As stated above, most analysts use a rate between 3.5% and 6% for the market risk premium. Alternately, they may proxy the return on the market with the return on the S&P 500. And finally, estimates of beta, as we noted in Chapter 6, are noisy. We can also use the discounted cash flow method or the constant growth model. This approach requires an estimate of the dividend growth rate, which we'll explore on the next few slides. The current stock price and the last dividend are observable. We now have a second estimate for the cost of equity, 12.4%. There are three methods for estimating the growth rate. We could use the historical growth rate if we believe the future will be like the past. We could obtain analyst estimates online, but be aware, analysts usually estimate earnings growth, not dividends, and the rates may not be the same. Finally, we can use the earnings retention model demonstrated on the next slide. If we have the firm's ROE and its dividend payout ratio, both of which are expected to remain constant, then we can estimate the expected growth rate in dividends. Formulas on the next slide. Using the data from our mini case, retention ratio 38%, 1 minus the payout ratio. ROE 15%. We arrive at a growth rate close to what we used previously. What if dividend growth is not constant? We can still employ the model, but it gets very complicated. This approach is covered in the Chapter Toolkit if you really want to explore it. Finally, the own bond yield plus risk premium approach. It uses historical data from Ibbotson and Associates detailing the spread between various levels of corporate bonds and the stock of various size companies. For example, the spread between AAA-rated bonds and large company stock over time. For our problem, we're using a 3.2% spread, which yields a cost of equity of 13.2. This is a ballpark number. It's mainly used as a check against the other methods. So here are our estimates, nicely grouped. We can use the average of the three or choose the one we have the most confidence in. At this point, we've got all the component costs we need to calculate our firm's weighted average cost of capital, which we'll do in Part B.